Have you ever let a potential investment opportunity slip right out of your hands? Doesn't matter if it's the stock market, crypto, or real estate. Watch this video till the end to learn how you can spot promising investment opportunities and grow your wealth. You are watching The Financial Educator, here to teach you what they should have taught you in school. Many believe that investing is for the rich or the privileged with stacks of cash, but that simply isn't true. At least not anymore. In a world equipped with technology, everything has been automated and made easier, including investing. So what has been keeping you from investing? If you think you lack expertise or simply don't know when to start, then this video is for you. Keep watching. Acquisition of assets or financial securities to generate income or capital growth is known as an investment. An asset's value increasing over time is referred to as appreciation. When someone buys a product as an investment, they don't intend to consume it right off the bat. Instead, they want to use it to make money later on in the future. There is always some risk involved with an investment because it is focused on the possibility of future economic growth. There is no guarantee that an investment might produce any revenue. Instead, it could even devalue over time. You could end up investing in a business that goes bankrupt or a venture that never gets off the ground. Savings and investing can be differentiated from one another primarily by the fact that saving involves building up funds for future use with no risk involved, while investing involves leveraging funds for a potential future gain with some risk. Now you might be wondering, if there is a clear downside to investing, why do people continue doing it? Investing is a successful approach to use your money and possibly increase your fortune. Your money may grow in value and outpace inflation if you make wise investment decisions. You lose out on chances to raise your financial value if you don't invest. The power of compounding and the risk-return trade-off is the main reason why investment has a stronger potential for growth. Compound interest accelerates your money's growth since it calculates interest on both your original principal and the interest accumulated over time. Compounding can produce a snowball effect as the initial investments and the income generated by those assets rise simultaneously. The potential return and market risk offered by different investments can vary. How much risk you're willing to accept in exchange for a substantially greater reward is entirely up to you. You get to choose your investment vehicle, and you can opt for whatever suits you best. Therefore, amidst the risks lie great opportunities to multiply your wealth. You can accomplish significant financial goals by investing. You will make more money over the long run and more quickly if your investments are yielding a better rate of return than a savings account. You can utilize this investment return to help you achieve important financial milestones like buying a house or a car, starting your own business, retirement, or perhaps paying for your kids' college. Now, before we address the main question, tell us in the comments section below what you think might be the right age for investing. Let's see. You might not know it yet, but you are always ready to invest. As the old Chinese proverb goes, the best time to plant a tree was 20 years ago. The second best time is now. The same holds for investing. Unless you are drowning in debt, then well, that might not be a good time to start investing. But if you have your bills cleared and you have an emergency fund sacked away, then you shouldn't be worried. You are now ready to embark on your investing journey. It doesn't matter what age group you're from, young or old, you will end up thanking your future self anyway. There is never a good or bad time to start investing. What counts is that you make a wise investing decision and invest thoughtfully. To achieve your financial goals, it is crucial to create a solid financial strategy and commit to it no matter what. Uncertainties in the market and the economy rarely disappear. When one episode is over, another one starts. Therefore, don't dwell on the current situation and have a long-term mindset. Delaying your investments could eventually result in a huge opportunity lost. If you are just beginning, you don't have to get yourself rooted in the stock market right away. You can always explore more investment options and you will end up finding something that would be perfect for you. All you need is a bit of research and ground knowledge, exactly what we are here to provide you with. So why don't you take this moment to subscribe to our channel to become a part of our financial quest and keep yourself updated with the financial world? Moving forward, being able to identify financial securities as explicitly good or bad would be valuable for someone looking to find reliable investment prospects from the plethora of available options. However, it's not that straightforward, and a portion of the process depends on your own judgment. There are certain warning signs that could indicate an uncertainty that ends up being a loss, along with other encouraging signs that could ultimately lead to a profitable success. More and more investment opportunities are becoming available to potential investors, but not all of them are good choices. In fact, as more opportunities become available, the probability increases that you will first come across an opportunity that will leave you broke before eventually finding the one that will fill your bank account. Warren Buffett, chairperson of Berkshire Hathaway and a renowned investor, said, "The most important quality for an investor is temperament, not intellect." You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. That means investing is a lot more about emotional intelligence than it is about IQ. So despite your age, what are some techniques that can equip you better for the world of investing? It's essential to be able to analyze chart data if you trade stocks, currencies, or anything else in between. The price changes of investable assets are almost universally displayed as charts, since they are simpler to read and follow over time. Being able to look at price movement charts, interpret them correctly, and then use this analysis to find good possibilities to take is a skill that is frequently required to identify good investing opportunities. Of course, being able to properly interpret charts will also let you know which investments you should avoid. Although many investors will utilize tools to assist them, you still need to understand what the chart is showing you and what you should be looking for. When you overpay for an investment, you put yourself at a disadvantage. Good assets are typically purchased at a fair price. Stock investing relies heavily on valuation in relation to expected growth. Despite the limitations of market timing, stock value is a significant factor in predicting future returns. Although buying at a fair price is not always the same as value investing, the pricing should always be fair and based on realistic economic forecasts. This technique holds specifically true in the current economic environment. With uncertainty in the stock market and real estate industry, this might be just the thing that could allow you to build a generational wealth. Don't know what we're talking about? Well, click on the link above and watch our video on how to get rich in a recession. Any investment you include in your portfolio should be profitable while simultaneously increasing the portfolio's diversification. Reducing portfolio risk and volatility also benefits from adding investments and funds from asset classes with low correlation to equities. You need to avoid the possibility of your investments becoming overly associated. This will protect value in the event of a stock market crash or bear market. Even though you might initially assume that this indicates that a company is struggling, companies that buy back their shares are actually doing so to increase the wealth of their current and long-term shareholders, which represents a more profitable investment opportunity. This means you will have bigger share profits without having to make a greater initial investment. A business that is run simply may not have much to catch people's attention, but it also increases the likelihood that it will be steady and have a positive growth curve. This is due to the fact that a straightforward business strategy is easier to adopt and makes it possible to launch new stores more quickly. More stores translate into more customers and visibility, which leads to higher earnings. If you found this video helpful, then give it a like and subscribe to our channel to join us on our financial quest. Also, don't forget to turn on the bell notifications to receive updates of our future videos. Thank you for watching. Happy investing!